Hello everyone, today I will be discussing merchandise sale journal entries. And now when a good is sold for cash, two journal entries must be made. The first one consists of a debit to cash, and we're going to say this good was sold for $500. And a credit to sales revenue for the amount that the good was sold for. Now the second journal entry that must be made consists of a debit to an expense account called cost of goods sold. And the amount that gets debited here is the inventoriable cost of the good. That means it's the value that it carried in the inventory account when it was in the inventory account on the balance sheet. And we're going to say the good's inventoriable cost was $300. And then a credit to inventory since the good is no longer in inventory and it was sold. So you have to debit the cost of goods sold by the same amount that the good carried while it was in inventory, the inventoriable cost of the good. Now the next journal entry I'd like to show is if there was a sales return or an allowance allowed on the product. Now an allowance is when a consumer gets some money back for the good because some aspects of the good will be defective. So, when a good is returned or an allowance is allowed on it, there's a debit to an account called sales returns and allowances. And two journal entries must be made under this circumstance as well. And we're going to say the value of the good that was returned is $500. And now there's a credit to cash, since you have to return cash to the customer if they return the good or an allowance is allowed on the good. Now the second journal entry that must be made here is a debit to inventory, since the good will now re-enter inventory, and that is the inventoriable cost of the good, so we're going to say $300, since it's the amount that the good was valued at while it's in inventory, not the value that it was sold for. And then you credit cost of goods sold, since the good has no longer been sold. And you credit it for the inventoriable cost of the good, so $300 in this circumstance. Now if a good is sold to a customer on account, there's two journal entries that must be made there as well. And the only difference between when the good is sold for cash and when the good is sold on account is that in the first journal entry, instead of debiting cash, you debit accounts receivable. So here we're going to debit accounts receivable for $500, and we're going to credit sales revenue for $500. And then debit cost of goods sold, just like in the entries if the good was sold for cash. Debit this for $300. And then credit inventory for $300. Now the last journal entry I'd like to show here is if there was a sales discount. Say a good was sold on account and there's a discount for paying off that account receivable in a certain amount of time. And say it's a 10% discount here for the customer. So what we would do here is if the good was paid off, the account was paid off for the good by the customer, and there was a 10% discount for paying it by a certain time, and the customer did that, so they get a 10% discount on the good. We would debit cash for the amount of cash we received, and if there was a 10% discount here, then the amount of cash we receive is $450. And then we also debit an account called sales discounts, and we debit that for the value of the discount, which in this case would be $50. And then we'd credit accounts receivable since the account receivable will no longer exist. And we'd credit that for the full amount, $500, because you see the debits equal the credits. It's one of our basic accounting rules. And if you have any questions, please leave them in the comment section down below, and thank you for watching.